global financial landscape is shifting beneath our feet, and the implications for the United States economy are profound. Recently, major global creditors, most notably China and Japan, have been recalibrating their portfolios, collectively reducing their exposure to United States government debt by an estimated $134 billion. This movement is not necessarily a sudden act of panic, but rather a calculated strategic shift in response to changing economic conditions worldwide. As the United States navigates a colossal $39 trillion national debt, the arrival of a new Federal Reserve Chair, Kevin Warsh, brings a new focus to monetary policy and inflation metrics. This moment requires a deep examination of how the Fed plans to reconcile the government's need for affordable borrowing with the realities of inflation as experienced by everyday Americans. To understand the weight of this development, one must first appreciate the scale of the fiscal environment. The United States national debt now stands at a staggering level, with a portion held by the public exceeding the entire annual economic output of the nation. The cost of servicing this debt has become one of the single largest obligations in the federal budget, eclipsing even national defense spending. As interest rates remain elevated, the Treasury is forced to navigate a difficult path, balancing the need to attract international buyers for its debt with the imperative to keep interest payments sustainable. For years, Japan and China acted as reliable primary purchasers of American Treasury bonds. However, their internal economic incentives are evolving. With domestic interest rates rising in Japan, for instance, institutional investors there are finding more attractive risk-adjusted returns within their own borders. This change in appetite forces the United States Treasury to compete harder for capital, essentially meaning that the era of nearly unlimited low-cost borrowing is being tested. When these major international buyers pull back, the demand for American debt instruments at auction faces pressure. Recent Treasury auctions have reflected this cooling demand, with the government forced to offer higher yields to incentivize investors. While these auctions have not failed in the traditional sense, they have highlighted that the cost of borrowing is rising. In response, the Treasury has leaned heavily into issuing short-term debt instruments, a strategy that temporarily lowers costs but increases vulnerability to sudden market shifts and refinancing risks. As the Congressional Budget Office projects future interest costs to consume a larger slice of the economic pie, the question arises of how the Federal Reserve will manage this tension. The strategy highlighted by the new leadership at the Federal Reserve involves a potential shift in how inflation is prioritized and interpreted. By focusing on metrics such as the trimmed mean, which seeks to filter out volatile components of price changes, policymakers may be aiming to define an underlying inflation trend that appears more manageable. However, this creates a significant divergence between official economic narratives and the lived experience of the average household. For consumers facing rising costs in essential categories like food, energy, housing, and insurance, the official numbers often feel disconnected from reality. This is not merely an academic disagreement over statistical methods, it is a critical policy lever. If the Fed can point to a lower inflation measurement, it justifies maintaining a more accommodative monetary policy, which ultimately helps keep borrowing costs lower for the government. This dynamic illustrates the concept of financial repression, a historical mechanism where a government manages a heavy debt burden by keeping interest rates below the prevailing rate of inflation. In this scenario, the real value of the debt erodes over time because the dollars used to repay it are worth less than when they were borrowed. For the government, this is a form of relief, as it allows the debt to be managed without resorting to politically difficult austerity measures or drastic tax increases. For savers and those holding cash, however, this strategy functions as an invisible tax, slowly diminishing their purchasing power. The market is already signaling its awareness of this underlying pressure. The performance of assets like gold, which has reached historic highs, and the demand for Treasury inflation-protected securities, demonstrate that institutional investors and sovereign wealth funds are increasingly hedging against the prospect of persistent inflation. This suggests a growing skepticism that current policies will be sufficient to restore stability without a long-term erosion of currency value. The spread between short-term rates and long-term borrowing costs in the mortgage market further reflects this lack of trust in the long-term outlook. As these developments unfold, the economic environment is creating a clear distinction between different participants in the financial system. On one side are those who hold cash, rely on fixed income, or see their wages lag behind price increases. These individuals face the brunt of the inflationary impact. On the other side are holders of hard assets, owners of businesses with pricing power, and borrowers with fixed-rate debt, who are structurally better positioned to navigate an environment where nominal dollar values are shifting. The government, being the largest debtor, arguably gains the most from this environment, provided that inflation can be maintained at a steady, manageable level that does not spiral into systemic instability. The critical question for the future is not whether the United States can continue to service its debt, but rather the quality of the currency used to make those payments. If the path forward involves a continued reliance on strategies that effectively dilute the value of the dollar to ease the fiscal burden, it will reshape the landscape for wealth preservation for decades to come. The decision by countries like China and Japan to pull back funds is not just a headline about bond yields, it is a signal that the global financial community is watching these developments closely. The new leadership at the Fed faces a monumental challenge: managing a fiscal crisis where the incentives for the government and the experiences of the public are pulling in opposite directions. The outcome of these policy decisions will dictate the future of the dollar's strength and the standard of living for the American populace for a long time to come. It is a complex machinery of incentives, and understanding it requires looking past the surface level of daily news to the fundamental trends that are driving these structural changes.